Only a few months ago, Forbes ranked Silicon Valley Bank as one of the top 20 US banks for 2023. Unfortunately, this once respected financial institution has now come crashing down, making it one of the biggest bank failures in American history. The collapse was so sudden that it left many stunned in panic. To get things under control, the financial regulators had to shut down the bank on Friday, March 10, 2023. In the midst of ongoing economic uncertainty, the implosion of Silicon Valley Bank has sent shockwaves through the industry. While some may have anticipated the bank's troubles, no one expected its swift closure immediately after announcing its difficulties. This event is likely to have a significant impact on people and may even signal the beginning of another economic depression. In today's video, we will explore the events that led to the downfall of Silicon Valley Bank, the second largest bank collapse in US history. The downward spiral began on Wednesday when the bank announced that it needed $2.25 billion to balance its financial records, which left investors reeling. Within just 48 hours, the panic had spread across the venture capital community and Silicon Valley Bank's 40-year history came to an end. This sudden turn of events highlights the fragility of the financial industry and the need for greater oversight and regulation. As we examine the events that led to this catastrophe, we must also consider the broader implications for the economy and the steps that must be taken to prevent another devastating financial crisis. The fall. How it all began. The collapse of Silicon Valley Bank, or SVB, is a cautionary tale of how interest rates can make or break a financial institution. Just a year and a half ago, SVB invested a staggering $91 million in bond securities due to an influx of capital deposits. However, the bank's fortunes took a sharp turn when the Federal Reserve Bank began aggressively raising interest rates. The bank's loss is tied to the recent rise in interest rates, given that the company's U.S. Treasury holdings were purchased when interest rates were still relatively low. At the time of investment, SVB's bond portfolio is set to yield 1.79% over a period of 3.6 years. While the current U.S. Treasury bond yields 4.7%, a far cry from the rate at which the bank purchased Treasury notes prior to 2022. Generally, when interest rates rise, bond prices decline, and existing bonds' market prices fall instantly because new bonds come into the market and offer higher interest rate payments. As a result, SVB faced interest rate risk on its huge funds and bonds. Moreover, as startup clients withdrew deposits to keep their businesses afloat in the ongoing economic crisis, SVB found itself short on funds. Aside from all this, the bank also primarily loans to venture capital and private tech firms, which frequently rely on the IPO market to cash in their equity holdings and raise money, which is frequently stored at the bank and thus helps boost available deposits for the bank. However, since the IPO market has been officially closed the past year, SVB Financial has seen a steady reduction in deposits. The bank was really out of cash, and this compelled it to sell all its available-for-sale bonds at a loss, which caused the value of SVB bond investments to plunge. According to the Financial Times, the company completed a fire sale of its $21 billion bond portfolio and suffered huge losses of around $1.8 billion. To cover up for the losses, the bank announced plans to raise an additional $2.3 billion from investors by selling stock, essentially expanding stakeholders. The decline in SVB Financial dragged down the entire banking sector, sending shockwaves through the industry as investors wondered if problems at the bank could be prevalent at other growth-oriented banks. In the blink of an eye, the credit rating agency Moody cut SVB's credit rating to Baa1 and downgraded the bank's credit outlook to negative because of the potential negative implications for SVB if the declining venture capital investment activity and high cash burn do not subside. SVB's collapse is a cautionary tale of how interest rate movements can impact financial institutions that invest heavily in bonds. When interest rates rise, bond prices fall, causing market prices of existing bonds to decline. This, coupled with other factors such as reduced deposits and increased interest rate risk, can lead to a bank's downfall. As such, financial institutions need to be cautious and vigilant in their investment strategies, especially in times of economic upheaval. The death blow. Silicon Valley Bank was one of the most prominent banks in the tech investing sector. Founded in 1983, it had become a critical partner to many startup founders and venture capitalists. However, on a fateful Thursday in 2023, rumors began to circulate that the bank was in trouble. By the end of the day, customers had withdrawn a huge sum of about $42 billion of deposits, according to a California regulating filing. And by the close of business that day, SVB recorded a negative cash balance of $958 million. Ryan Falvey, a former SVB employee who founded his own venture enterprise in 2018, likewise blamed the bank's failure on the extremely interconnected structure of the tech investing sector, stating that his analysis of SVB's mid-quarter update as of Wednesday gave him confidence that the bank was well capitalized and could manage the crisis, he said. He even counseled his portfolio companies to keep their funds at SVB even amidst the chaos and rumors. Nothing could be more devastating than seeing prominent firms such as Union Square Ventures and Coatue Management send out emails to their entire rosters of startups instructing them to pull out their funds from SVB on concerns of a bank run. Social media only heightened the panic, he lamented. SVB was certainly unprepared for this. This will go down in history as an example of an industry ripping its nose off to spite its face, lamented Ryan Falvey, a fintech investor at Rest Ventures. Because, as of Thursday evening, some SVB customers received emails reassuring them of business as usual at the bank. That is to say, everything was under control. SVB Financial CEO Greg Becker even reassured investors in a shareholder letter that SVB is well capitalized, with a high-quality liquid balance sheet and peer-leading capital ratios. However, by Friday, the value of SVB stock had plunged dramatically, and efforts to sell shares failed woefully. The abrupt withdrawal of deposits rendered the bank incapacitated and unable to meet all its obligations, thus leading to bankruptcy. The bank run ended in SVB's closure, but what would become of those who couldn't cash out all their funds before the bank shut down? Business owners are already concerned about meeting payroll, which might lead to unexpected closures and layoffs. "It's horrible," said one venture capitalist. "Our hearts go out to everyone who had been impacted." However, the story does not end there. Silicon Valley Bank was closed by regulators, which are now in charge of the bank's deposits. According to Bloomberg, the U.S. Federal Deposit Insurance Corp., which intervened and shut down SVB on Friday due to an extraordinary rush on money by its clients, sought to complete the auction for the bank remaining assets before markets opened the following week. Of course, a quick sale could enable the FDIC to make at least some of the SVB clients' uninsured deposits available to them as soon as possible. Already, the U.S. agency has stated that the insured sums will be made accessible in full within a few days. The failure of Silicon Valley Bank serves as a warning to both investors and entrepreneurs. It highlights the importance of diversifying risk, maintaining a healthy skepticism about rumors and gossip, and having a backup plan in place. The ripple effects. The recent collapse of Silicon Valley Bank has triggered panic in an already slumping stock market, sending shockwaves through the banking industry. To add to the chaos, crypto-oriented bank Silvergate Capital announced that it would cease operations, leading to a further round of deposit withdrawals. This, in turn, led to a 40% drop in Silvergate stock and an 11% drop in Signature Bank, which has some ties to the crypto industry. The severe downturn in the banking sector has made investors increasingly risk-averse, with concerns growing about potential sector contagion. The effects of SVB's collapse have been felt across the industry, with bank stocks plummeting since the news broke. JP Morgan Chase, Bank of America, and Wells Fargo's shares all dropped more than 5%, while the regional banking sector plunged as much as 8%. The decline accelerated throughout the day, with SVB Financial shares falling as much as 62%. The KBW Bank Index also fell 7.7%, marking its greatest decline since June of 2020. The unexpected news at SVB Financial highlighted the fact that a prolonged downturn in private markets and venture capital had reduced its deposit levels. This, in turn, pushed down other California-based banks such as PacWest Bancorp and First Republic, with shares falling by more than 20% and 15% respectively. All these reflect how fragile the financial institution is. Considering the instability of the banking system, investors are increasingly anxious about where they can keep their money safe. Explaining the bank's current situation or demise will obviously not stop the ongoing panic. The story is fast-paced and ever-changing, though we are made to believe that the main cause is an unusual bank run. But any underlying long-standing causes of SVB's collapse will undoubtedly be revealed in the coming days. As the impact of Silicon Valley Bank's implosion begins to unfold, it's becoming increasingly clear that this is not an isolated incident. The failure of crypto-oriented Silvergate Capital is another sign of this uncertainty that surrounds the banking industry, particularly in the current global economic state. As concerns about potential sector contagion continue to grow, investors will likely become even more risk-averse, leading to further declines in bank stocks. Nevertheless, we long to see how this will play out in the long run, but it is evident that the aftermath of Silicon Valley Bank failure will affect so many sectors and the nation's economy at large. Enjoy the video? Now watch this one.